Next, we're going to start doing a deep dive into the qualification process for a mortgage loan. It's important to look at the transaction with the lender really as a partnership. A lot of the time, most of us are leveraging money, like we talked about through the down payment, where we're only going to bring 5, 10, 15, 20% of the entire purchase price. Well, that means that the mortgage lender is typically going to be on the hook for the difference, right? So that will be, 80, 90% or more of the actual transaction is going to be funded by the lender. So it's important to understand, just like in any partnership, what your partner is looking for. And really nowadays, what mortgage lenders really try to focus on is on your ability to repay the loan and make sure that this is a comfortable monthly payment or monthly obligation for you or your family. So how does the lender decide whether or not you qualify for a $400,000 loan or $1 million loan? And the answer is pretty simple. It's all about your income and of course your ongoing debt obligations, or what you're obligated to pay on a monthly basis. Most of us understand that prior to the Great Recession, it was somewhat like the Wild West out there, right? Meaning lenders would approve almost anybody for a home. And what that led to was a complete catastrophe and almost meltdown of the entire US economy. So nowadays, again, what lenders really look at is your ability to repay the loan, and most of this is built around your debt to income ratio, which we're going to go into further detail in a little bit. Lenders carefully analyze your income and your monthly debt to make sure you have enough wiggle room, plus money left over to afford your lifestyle and maybe emergencies that sometimes pop up throughout life. This qualification process is our financial system is in a much better position compared to in 2008 after the great housing crash or the Great Recession. So it's important, again, to understand what these lenders are starting to look for, and we're going to jump into more detail here. Let's begin with your income. Mortgage lenders are always going to have to qualify your income. So it's very important to understand how and what the lender is looking for when they're qualifying your income. Unfortunately, there's a lot of rules when it comes to qualifying people's income, and a lot of the time the lender can't simply take face value for the income or the income that we think we're receiving on a monthly or annual basis. A simple rule of thumb is this: if we're paying income tax on the income, that's the first step to a mortgage lender being able to use that income. However, if we are not paying income tax on that income, automatically that's going to be disqualified as usable income that you can use to then qualify for your loan. So for example, if I just bought a rental property last month and I started to claim this income, the lender is going to tell me, hey, you need a 2-year history or at least a 1-year tax return showing that you've paid income tax before they're going to use that as income that can qualify, that they can use to help you qualify for a mortgage. So most people understand that when it comes to our income, this plays a huge role in qualifying for the loan type, but also the loan size that we want to qualify for. Let's start with W-2 employees, salaried and hourly. These are going to be more straightforward. Okay, these are easier for almost all lenders to qualify borrowers using this type of income. So in almost every situation, the lender is going to simply request 2 months worth of your most recent pay stubs and 2 years of your W-2. And what they're looking for, they're looking for a trend. And as long as things are consistent or at least moving in an upward direction, they're going to use the face value of your pay stubs over the last 2 pay periods. So for example, if you make $5,000 a month for a salary or $10,000 a month for a salary, and it's been consistent, or you've gotten a couple raises over the last couple of years, the lender is just going to simply use that as, take that income as face value and use that income to qualify you. Let's talk about variable income with W-2 employees. This can be in the form of overtime, bonuses, commissions. Lenders require a 2-year history of receipt when it comes to this type of income. Otherwise, it is not looked at as continuing or a valid source of qualified income. So for example, if I just took a commission job and commissions just started to show up on my most recent pay stub, the lender's only going to be able to qualify us based on my salary and definitely not my commissions. Now, if I have 2 years worth of history of receiving these types of commissions or bonuses, for example, the lender is going to take this at face value, do an average of the variable income over the last 2 years, and use that as additional income that will help me qualify for a larger loan. Let's move on to self-employed individuals or independent contractors or entrepreneurs. When it comes to this type of income, like I stated in the beginning, you need to have a history of filing taxes as an entrepreneur or self-employed business owner. This is extremely important. If you don't have a 2-year history, almost all lenders are going to tell you that they cannot use this type of income. So it's important when you're getting ready to buy a home. So for example, if my plan is to buy in 2024, 2025, and 2026, and I'm self-employed just like I am, I would tell my CPA right away, hey, listen, my goal is to buy a home in 2025 in this example, because it is definitely going to impact the way that your CPA files your taxes. And really the way that they look at it is they want to use and be able to help you qualify for more income, to qualify for a higher loan, or make the process easy on you. If you have questions on how does this work, or what type of income do I have, or what type of income would I be able to qualify using, or if you just have a complicated income situation and want to learn more, you can download our income cheat sheet, which is available in the link below. This is going to be a plug and play model. Now, this isn't foolproof, right? Because almost all lenders have a different viewpoint on how they see these rules and these federal guidelines, but this should give you a very close and accurate picture of where you stand and what type of income you can actually use. Don't forget, I've said it multiple times throughout the class, but just in case, if you have questions about income, what's usable, what's not, hit me in our chat function. I'm happy to answer your direct questions. So next, let's talk about debts, which are equally as important when it comes to your debt to income ratio and qualifying for a mortgage loan. Making a ton of money doesn't necessarily mean that you can afford to buy your dream home, or that you're necessarily ready to buy a home. I have seen plenty of students and plenty of clients over the years who make $300,000, $400,000, $500,000, but carry an equal amount of debt or monthly obligations. This can eliminate you altogether from being able to buy a home. So it's important to understand that what a lender truly is looking at are what are the monthly obligations or the minimum payments that you have to make to service your debts on a monthly basis. So let's talk about what debt matters and what the lenders will count against you. So let's start with credit cards. If you're carrying debt, of course, the debt burden or total amount matters, but it doesn't really matter to the amount of home that you can qualify for. The most important number is your monthly minimum payment. So for example, if I have $30,000 of outstanding debt, but with a small $100 payment, this isn't going to impact my debt to income ratio nearly as much as having a $5,000 credit card that has a $300 or $400 or $500 monthly minimum payment. The minimum payment is factored into that debt to income ratio. So just remember, if you have credit cards that have a large minimum, these should be your priority to pay off when it comes to purchasing, or if you're gearing up to purchase a home. Next, which almost we see on all credit reports, are car payments. Whether you're financing or you're leasing, these payments are counted against your debt to income ratio. So it's important to understand if you can hold off, right? If you need to purchase a new car, but you want to buy a home soon, if you can hold off and just drive, a beat up car a little bit longer that doesn't necessarily have a payment, I would definitely advise to do that rather than go out and buy a brand new car that's got a $1,200 payment, because you're going to be reducing your potential purchase price of a home by hundreds of thousands of dollars. So it's something to think about, is just making sure that our car payments fit our lifestyle and fit within, our budgets and our income. Next are student loans. If you're on a fixed plan, the lender is going to use your monthly minimum payment. However, a lot of us, especially after the pandemic, have deferred student loans. If that's the case and you're not starting to make payments yet, the lender is typically going to use a 1% of your loan balance as your monthly minimum payment. This can be reduced to a 0.5% depending on the loan programs that you qualify for. But to be safe, just assume that the lender is going to take 1% of your total outstanding student loans and use that as your monthly debt obligation to be servicing your student loans. Next, what also is part of your debt is, of course, your housing payment. So this portion is important. So when you're qualifying for a mortgage, you also have to be able to qualify for the associated property taxes, homeowners insurance, and HOA dues or fees if there are any. So it's something to consider is, how we come up with this monthly payment. We're going to go into that in more detail, but it's important to figure out again, what is this debt to income ratio that is the kind of the magic line in the sand that the mortgage lender is going to draw. So we're going to go into the next section about how we come up with our projected monthly payments. But before we do that, we're going to make a quick pit stop, and I'm going to show you a little bit more about debt to income ratio. All right, let's do that deep dive into debt to income ratio. Debt to income ratio, again, is just that line in the sand that almost all lenders are going to use when qualifying their borrowers. If you exceed a particular debt to income ratio, you're going to be disqualified for the loan altogether. So for most loan programs, you can go up to about 50%, 45 to 50% of debt to income ratio. Let's go through an example together, and let's talk about exactly what these lenders are looking for. So DTI is our biggest test when it comes to understanding if you're qualified to purchase the home that you want. The debt to income ratio simply equals your monthly obligations over your monthly gross income. Low DTI ratios exemplify a borrower who's likely to manage debt effectively and have a lot of excess income. This means that this borrower is going to be a very low risk of defaulting or missing payments altogether. The higher the DTI, the higher the risk, as more of your income is going to just servicing your debt and paying off your expenses. Remember, the higher the DTI, the higher the risk is directly to the lender. Having a higher DTI will sometimes impact the loans you qualify for and also the interest rates that are offered to you. So let's go through the different limits that are available on most common loan programs. On conventional loans, if you're using a Fannie Mae product or our federal agency Fannie Mae product, you can go up to about 50%, 49.9%. If you're going to use Freddie Mac, you can go up to 50.5%. On FHA, they're a little bit more loose, and we see approvals up to 55, 56% debt to income ratio. VA loans are definitely the most forgiving for a reason. VA loans typically come as a lower cost options for our veterans and active duty members. We've seen debt to income ratios from 45 all the way north of 65% be approved through the VA on a VA loan. And then jumbo loans, so loans that are in excess of your county loan limits, again, think about loans that are closer to the $1 million mark. These are going to have much stricter debt to income ratios, closer to between 40 and 43%. Like I mentioned, there are particular programs that allow an excessive debt to income ratio, 65 plus, but that doesn't really mean that that's an affordable payment or an affordable budget for you as a consumer. The saying that I use with my students and my clients all the time is affordability is defined by you. So you have to be very comfortable with that monthly payment coming out of your bank account each month. Just again, think of the debt to income ratio as the line in the sand that the lender draws. That doesn't mean just because they're going to approve you at a 50% debt to income ratio that it's something that you should necessarily chase or be comfortable with. For example, if a housing payment that fits within your debt to income ratio is $4,500 a month, but you have it in your mind that the comfort zone is closer to $3,000 a month, I would stay closer to your budget and stay closer to $3,000 a month in this example. Now, if a dream house comes on the market and you're like, you know what, this one has a higher HOA fee, for example, and it's $500 more, and that's still bumping up against the higher limit that you're comfortable with, but not exceeding your debt to income ratio, this might be worthy of an exception. So remember, DTI is only for determining the absolute maximum that you can borrow and qualify for. It doesn't necessarily mean that this is the right type of payment for you. So now we understand debt to income ratio and how it impacts our budget, our home purchasing budget. Remember, again, DTI is just simply the test that the lender is going to run to see how much of a loan that we can actually qualify for. I wanted to show you an example of how debt to income ratio can impact your home purchase price, but also how it's easy to manipulate your debt to income ratio to make sure that we're still hitting our goals and our objectives. So let's go through a live example together. Let's just say that you're a salaried employee making $120,000 a year or $10,000 a month. This means that you can have monthly debts not exceeding $5,000 per month. But remember that our housing payment also has to fit within that $5,000. So again, keeping the example easy, let's just say that you have $1,000 worth of debt obligations every month, which amounts to, call it $500 of your car payment and $500 of minimum payments on your student loans and your credit cards. That means that we have a housing payment that can fit within our debt to income ratio of $4,000. So let's just say today's interest rate is 6.5%. If you use a 6.5% interest rate to generate a $4,000 payment, that means that you can borrow or have a total mortgage amount of $485,000. But what if you wanted to qualify for a $495,000 loan or buy a $525,000 home instead of a $500,000 home? To solve this simple debt to income issue, we could do a couple different things. Number one, you could bump up your down payment, right? If you bring more money to the table, it's less money that you have to borrow. So that's always the first option. If it's easy enough for you to put more down, you can absolutely do that. Now, of course, as we know, interest rates adjust every hour, every day, and fluctuating interest rates have a big impact on debt to income ratios. So let's just say the rate drops from 6.5 to 6.125. That automatically solves any debt to income ratio you might run into. Now, another option would be to decrease your debts. Let's say you wanted to qualify for a higher loan amount or purchase a more expensive home. You could simply erase about $100 or $200 of a month of debt, and this will translate into borrowing another $20,000 to $30,000 on your mortgage. The last but not least, what we could always do is we could do a combination of some of these options, right? We could pay off a little bit of debt, we could buy down our interest rate a little bit, or we could do a little bit more down. Debt to income ratio, again, is not something that we can't overcome. So if you're having these issues, first of all, talk to your lender, right? If they're limiting the amount that you can borrow or qualify for, ask them directly. Hey, is this a debt to income ratio issue? And if so, what are some suggestions that you can see after reviewing my financial profile that I can make that would easily address these issues? What I always tell our clients and our students is don't give up on your dream. Meaning, if you want to go out and buy a $500,000 home and you have good income and your debts aren't excessive, most of the time you should be able to figure this out, right? Does it mean your spouse has to get a job? Does it mean you have to maybe sell a car? A lot of the times these things are a little bit more achievable. Don't give up on the dream, especially when it comes to debt to income ratio. I wanted to throw in a couple of extras for you. So I wanted to show you how easy it is to impact your debt to income ratio and also warn you of a couple of the pitfalls that we see a lot of our students make and our clients make over the years that negatively impacts their pre-approval amount and the amount of home that they can actually afford. Remember, it comes down to that debt to income ratio. So I'm going to give you a couple of things that can sometimes harm your pre-approval and then also some easy ways to increase your budget if it's something you're looking to do. Let's start with some things that are easy to overlook, but a lot of the times have a large impact on our debt to income ratio and our home buying budget. Be very wary of the property taxes. In a lot of states, property taxes vary from county to county. So if you're buying in a county that has very high property taxes, this is going to eat into your pre-approval budget. So one thing that I speak on a lot with our students is, and it's counterintuitive, but think of it this way. If you're looking in an area that isn't as well developed as it could be, meaning it's brand new and they're building a lot of new communities and new schools and new roads, a lot of the time how counties and municipalities pay for these types of improvements is simply by increasing property taxes. The closer you are to urban centers, and it is counterintuitive, but typically these property tax rates will be lower. So again, just be wary of your property taxes. Make sure it's something that you're paying attention to. Next, be wary of homes that are in very disaster-prone areas. The reason is your insurance is going to become much less affordable. And then if it's in a flood zone, for example, you have to carry additional flood insurance, which will be another $100 or $200 that gets factored into your debt to income ratio, again, lessening your pre-approved budget. Last is just be wary of the HOA fees or additional fees that when you're purchasing a property that you're going to be obligated to on a monthly basis. HOA fees are counted against your debt to income ratio, and they can go from being cheap, right, $65 in some new build communities, to $1,000 or $1,200 in more established, nicer gated communities. So be very careful. Amenities or paying for these amenities in the form of an HOA can impact how much home you can actually afford. So let's end this on a positive note. Here are some easy ways. We've already touched on a few of them, but here are a couple easy ways that we can increase our home budget. Remember, paying off debt is a magic silver bullet, right? So paying off a lot of debt, especially credit cards that have very high minimum balances, has a huge positive impact on your pre-approval and, of course, your home buying budget. Next, increase your down payment. We talked about this just a couple minutes ago, but just in case. You can always close the gap when it comes to debt to income ratio by simply closing that gap with cash and not financing the difference. Next, negotiate a lower rate with your lender. You should always understand what are the full options that you have when it comes to your interest rates. Can you prepay a little bit of interest to buy down the rate and that way squeeze a little bit more out of your home buying budget? Another thing to be very wary of is you can always refinance your rate. So if you have room on your debt to income ratio, sometimes it makes sense to take a very affordable, what we call a free interest rate, and then as long as your DTI can afford that, and then handling the interest rate at a later time by doing a refinance and accessing a much lower rate down the road. And then the last possibility, which is simply make more money or ask for that raise that you've been a little bit timid about asking for the last year or two. Tell your boss, tell your manager, hey, I'm buying a home. This is something that's super important to me and my family. A lot of the times you're going to see your employer wants to lean in, especially right now in a job market that's not easy for anybody to navigate. We see a lot of our students take this advice. We get a lot of messages through our chat function where students come back and say, you're not going to believe it. I told my manager I was buying a house and they gave me a $5,000 or $10,000 raise. So when in doubt, or if you need that extra little push, ask your employer. There's no harm in asking. In fact, most employers will agree when somebody asks for something, they're much more inclined to give it to them.